Hello family, thank you for tuning into this video today. Hey look, I've got something pretty exciting for you today. I'm going to jump in and give you a breakdown of the pros and cons associated with investing in sub-regional Queensland. So if you are a property investor and you're interested in investing in the regional Queensland property market, I think you're going to get some tremendous insight around how to tackle the sub-regional Queensland market. And if you are looking to invest in sub-regional, some of the things you need to be aware of before you do so, because there are associated pros and cons of investing there. So again, if you're an investor, stick around. You're going to get some tremendous insight. Cheers. Before we dive in, I'm just going to give the business a bit of a plug here. So my name is Troy Simbasini. I'm the owner and head of research of Capricorn Life Buyers Agency. And Capricorn Life Buyers Agency is one of our subsidiary brands under the Life group of companies. So we've got Capricorn Life servicing the Central Queensland area, Rockhampton, Mackay, Gladstone and Bundaberg. Then we've got Tropical Life in North Queensland servicing Cairns, Townsville and the Port Douglas region. Now, we purchased more than $200 million worth of property in the area. We buy a lot of property that's off the market. So we transact a lot with property investors and buy a lot of investment properties in these various regional Queensland markets. So we really know what's going on there, and we are abreast of the current conditions, past conditions, and future conditions around what the market is doing or likely to do in the future. So I suppose if you are someone that feels as though you might need help navigating the marketplace, or if you're an investor looking to get really good potential returns on your investment, if you're struggling and you're geographically challenged, feel free to reach out to me and the team. More than happy to have an initial chat to see if we might be able to add value to your investment journey. You can give us a call on that number here. You can visit us on that website. You can book a call with me and my team. Or alternatively, if you're just someone that's after further insight about the market, please subscribe to my channel or jump on Instagram and give me a follow on Troy Simbasini Property here. I put out a lot of free content on Instagram just about general market information about regional Queensland, as well as some property tips and tricks around how you can best navigate it. Now you're probably wondering, Troyson, what do you mean by sub-regional? I thought it was just only regional, but there's this term sub-regional. So just to define the term really quickly, so sub-regional, basically how I define it, is any location, potential investment location, outside of the bigger regional hubs in Queensland. Now the bigger regional hubs include places like Toowoomba, places like Hervey Bay, Bundaberg, Rockhampton, Mackay, Townsville, and Cairns. And then any location that sits outside of those bigger regional hubs, I consider sub-regional property markets. Now, I've given some examples here of sub-regional property markets. So around the Rockhampton region, sub-regional markets would include places like Blackwater, which is a mining town just probably say 1.5 hours outside of Rockhampton. Emerald, Billawheeler. In places like Bundaberg, you got markets like Childers, Gingin, and Agnes Waters. Around the Mackay region, you got Moranbah, which is quite a polarizing market for a lot of property investors. Places like Dysart, sorry, not Diehart, Serena, and then around Townsville, you got Charters Towers, Ayr, Ingham, and then around the Cairns region, you've got places like the Atherton Tablelands, Innisfail, Mossman, and Port Douglas. So that's basically what sub-regional markets mean, or sub-regional locations I'm referring to. So yeah, most investors, when they come to regional Queensland, they have a tendency to stay, to those big regional hubs, and often you get investors that go into these sub-regional locations. And this is the video that I'm going to do today, is weigh up the pros and cons associated with investing in these sub-regional locations, because it could potentially be a good fit for you, it could potentially not be the right fit for you. It all depends on the type of investor you are. But yeah, guys, that's basically a definition of sub-regional locations and what I'll be referring to today when I cover off these associated pros and cons. All right, let's dive straight in, guys, and have a look now at the pros associated with investing in a sub-regional Queensland property market, now that we've defined what a sub-regional market is. Now, I've got a bunch of pros here. I'm going to go through each one by one now. So the first one is One of the good things about if you were to park your money in a sub-regional location is that it's a lot cheaper, basically. So a lower entry price into the market. So yep, a lot cheaper. And this is very evident. And you can jump on realestate.com or Domain right now and search up different sub-regional locations. For example, somewhere like Billawheeler, just outside of Rockhampton, you might be looking at an entry-level 4-bedroom, 2-bathroom home on a 600 square meter block for around $350,000. Whereas that same property, let's say down the road to us, down the road in Rockhampton, you might be looking at around $550,000 or $600,000. So that's one of the pros associated with a sub-regional location, is that you can get in at a much more lower price and potentially get a like-for-like property to a major regional hub. So the lower entry price into the market is often a good thing about these sub-regional locations. And look, I'm not saying if you've got a low budget, go ahead and buy in a sub-regional location over a major regional hub. No, I'm just saying that properties have a tendency to be a lot cheaper there. So it is something you should consider, as part of your, investment criteria. However, it doesn't mean you just dive right in and jump right into these sub-regional locations just because properties are cheaper. Now, the next pro I've referenced here is that you'll often find, and it plays in a lot to the first point, is that often you get a lot more better value for money in a sub-regional location, meaning that 4-bedroom, 2-bathroom property on 600 square meters in Billawheeler outside of Rockhampton might cost you close to $650,000 for that same property if you were to pick it up and put it in Rockhampton. So you're often getting better value for money in a market like Billawheeler versus Rockhampton in terms of the property itself and the land content itself. And this could play into not only like for like properties, but a 4-bedroom, 2-bathroom property. Let's say if you were to spend $400,000 in a market like Billawheeler outside of Rockhampton, that might get you one of the best properties in that immediate area, right? It might get you something that if you picked it up and put it in somewhere like Rockhampton, it might be $700,000-$800,000 property because that land content isn't as valuable in those locations. Hence the lower purchase price, but what you get in terms of dwelling overall could be far greater. And not only dwelling, what you could get in terms of land content also could potentially be far better value for money. So in a sub-regional location, you might get a couple of acres for $500,000, right? For example, in a sub-regional market, whereas a couple of acres in a bigger regional hub might cost you close to $1 million. So all I'm saying is that in a sub-regional location, what you often find is that your dollar stretches a lot further, and then as a result of that, it gets you better value for money property. But does that equal better returns? No, I'm not saying that. All I'm saying is that for a like for like property versus what you can get in a regional location, a bigger regional location versus a sub regional location, you'll find that the sub regional property presents itself often as better value for money when you compare like for like. The next pro I've captured here is what you'll usually find in these sub-regional locations is that the yields are usually stronger. Take a market like Moranbah, for example, just outside of Mackay. It's been a popular investment hotspot for many years, right, for property investors. And often investors have invested in this location purely for its yield. And generally why these yields are so strong is because the entry price is so low and rents are high relative to that purchase price. So a property in Moranbah you might be able to pick it up for $350,000, but it might rent for $600 or $700 per week, giving you close to an 8% rental yield there on that property. So yields have a tendency to be a lot stronger in these sub-regional markets purely on the basis that the purchase price is lower and rents have a tendency to be quite high. So relative to the purchase price, you end up with that higher yielding property. And is that a good thing? It might be a good thing, particularly if you are an investor chasing high yields. Then that's potentially something you might consider doing, is going into a sub-regional location to go after these high yields, which is what many people have done in and around places like Moranbah. Now, another one on the list is what you'll find is that often there is a lot less competition, and obviously this is on a case by case basis. But what I mean by that is if you are in the marketplace and you're looking for a property, you might not find yourself in a situation where you're under multiple offers or you have to offer a substantial, huge amount over the asking price in order to get the property because there is less competition. So that means that you might have the ability to potentially get the property at a good price and negotiate a good price, which is the next item on my list there. So the less competition could be a good thing, right? For you as a property investor, it allows you to get into that marketplace sooner rather than later with very little competition, and it means that you don't necessarily have to pay a premium to get into that marketplace, right? And pay top dollar, which what you find in markets like Mackay, Rockhampton, Bundaberg, parts of Townsville, Cairns, people are well and truly paying right now 4, 5, 6% over market value to get these properties. But when you're in a market where there is less competition, the likelihood of this happening is not as high. But does less competition generally mean that that's going to be a good investment long term? Don't know, right? It's hard to determine that. But often when you're in a market where there is low levels of demand, that can equate to potentially lower and less long-term capital growth. So if you are someone that was considering, regional Queensland as a potential place to invest, and you now have sub-regional Queensland on your radar, or you were considering sub-regional Queensland also, these are my pros again, right? So lower purchase price or cheaper properties. What you'll find is you often get better value for money there. Usually the yields are a lot stronger. There is less competition, and as a result of the less competition, you might be able to negotiate a really good purchase or acquisition there. All right, now here are my cons associated with investing in sub-regional Queensland. With the first one being limited macro fundamentals. So we all know that fundamentals drive property markets, and the key fundamentals that drive property markets are things like population movement or population growth, things like infrastructure investment, things like lifestyle, right? They all play into sort of macro drivers. They're the things that really hold markets up and drive markets forward. And unfortunately, when you move into these sub-regional locations, they have a tendency to not have a lot of these major macro fundamentals. So these smaller sub-regional markets, often the population growth is going backwards or not as strong. So the long-term trend of population isn't good and overall population growth isn't great. So that obviously then translates or potentially can affect that property market over a period of time also. In addition to population movements, a lot of these sub-regional locations lack infrastructure spending or government investment and also private industry investment. So they have a lack of an economy in that area, and that lack of economy then doesn't result in job creation, doesn't stimulate that economy there locally, and doesn't then trickle down into the housing market. So the lack of macro fundamentals in these sub-regional property markets really, I think, limits its ability to perform as a property market because it doesn't have a lot of these pillars holding it up and driving them forward. So that can be a big con when you're investing in a sub-regional market. And I think it's something that you definitely need to consider because these macro fundamentals, as I said, drive markets forward. And if they're in absence in these locations, then how your investment is likely to perform long term, that's up for question. The next one I've noted here is that these markets tend to be more volatile in nature. So they have a tendency to be more boom and bust locations. And this is very evident, guys, when you look at a lot of the quantitative data in a lot of these sub-regional locations. One moment vacancy rates, let's say, are at 0%, And then 2 years down the track, vacancy rates are at 7%. 1 year, the market might be up 24% in capital growth, and the next year it might be down 12%. So these markets have a tendency to be quite volatile in nature. And I think as a property investor, you just need to be aware of that if you are looking to buy an investment there, because it may not be the best investment proponent, particularly if you're someone looking at just sort of a set and forget buy and hold investment and you don't have the capacity nor ability to hold property in volatile locations, because these volatile locations can also play into the fact that, if a vacancy were to skyrocket in an area due to, let's say, a major employer going bust in the area that employed a lot of people there, and those people move out of an area, you could potentially have a property that you own that's not occupied by a tenant for months on end. And we've heard of cases where people have bought in these places like Dysart, Blackwater, where they've had no tenant in these properties for 6 months or more, and up to 12 months even in places like Gladstone during the bust period there many years ago. So you just need to be mindful that if you are buying in a sub-regional location, these areas have a tendency to be more volatile. And often if you are an investor that doesn't have that type of risk appetite, then it probably might not be the right investment choice for you. Now, the next point I've made here is that what you'll find in a lot of these sub-regional locations is that they've had little to no long-term capital growth. Yeah, they might have up and down price fluctuations, but their long-term trend generally isn't that great. Usually, you can buy a property there for $350,000 in a quite decent, let's say, sub-regional location. But if you backdate that property 10 years ago, you probably could have picked it up for around that same price. Or if it has moved, it's only moved the best part of $20,000, $30,000, $40,000. So there is not a whole bunch of long-term capital growth in these marketplaces. And the data speaks to that. And I think it comes back to a lot of these macro fundamentals. So there's not a whole lot of things there that can continue to put upward pressure on house prices, like people moving into the area, massive government investment, lifestyle amenity. Like there is often not enough of these sort of stuff in these sub-regional markets to put long-term pressure on house prices. So that's something that you do need to be aware of if you are intending to potentially go into a sub-regional market. And if you are an investor that really needs capital growth, then you have to be considerate of that and look at the individual track record of each sub-regional market before you invest. Because what you find is that a lot of these markets don't have the best long-term track records. A couple more here, guys. So I've noted that what you'll find is the holding costs tend to be a lot higher also in these sub-regional markets, and that's generally because it's more isolated away from major catchments. So in places like, let's say, Ingham, just outside of Townsville, the average property there might cost you $6,000 per annum for insurance cover, right? Whereas in Townsville, you might be looking at 4,000 or 3,500. So what you'll find is as you go into these sub-regional markets and become more isolated, holding costs can be a lot higher with things like insurances, rates, maintenance costs, repair costs, etc., because you're so isolated from the bigger economies, the commerce districts, etc., the trade routes. So that can create higher holding costs. So if you are an investor that doesn't want to have a property that is costing you a lot to hold, then maybe a sub-regional Queensland location isn't the right fit for you. But that tends to be a major con when you're investing in sub-regional locations, is the extravagant costs it takes to hold property. And if you are someone that almost fell off your chair when you just looked at the numbers associated with Townsville, or looked at the numbers associated with the holding costs with Mackay, try having a look at some of the sub-regional locations. You'll break your chair, because those costs have a tendency to be 10, 15, 20 times more higher to hold property in these locations. So there you go, guys. Those are my cons associated with investing in a sub-regional location. So again, very limited macro fundamentals, so lack of government and private investment, lack of population growth, lack of potential good lifestyle opportunities. The markets tend to be more volatile, so very boom and bust with high vacancies, low vacancies, high price growth, low price growth. They tend to be, not as good long term. So when you look at the data over a long period of time, what you find is that the trend isn't as good, and there is no generally good long-term capital growth. And as a result of that, what's generally driving that is a lack of some of these big fundamentals and higher holding costs. And yep, as a result, these higher holding costs are as a result of these locations tend to be more isolated away from sort of major trade routes and bigger tradable and commerce areas. So yep, guys, those are my cons associated with sub-regional markets. All right, so my overall take and conclusion on buying an investment property in a sub-regional market. So I always tell my clients I would only invest in a sub-regional location if I've got the ability to take on higher risk, meaning I'm an investor with an established portfolio. I've had some properties in my portfolio that have done quite well. I might be 4, 5, 6 properties deep, and now I've got the ability to take on additional risk because I've got an established portfolio there. I wouldn't necessarily suggest to invest in a sub-regional location if you're buying your first, second, or third investment. It's only when you have the ability to take on higher risk after you've got an established portfolio. So that's one of my reasons. Or I no longer believe I can achieve my desired investment goal in a bigger regional location. So on a case-by-case basis, if I look at a big regional location for my budget and investment goal, and I decide, oh, well, if my goal is to potentially buy a big, decent sized land parcel in a big regional hub, and I've got a budget of $500,000 with the intention as a strategy to subdivide that block of land up into 10 potential lots, then that budget may not give me the desired investment result or goal that I have. So I might look at going into a regional market where I can spend the 500. I might go into a sub-regional market where I can spend the $500,000 and get something that ticks all the boxes, get the right dwelling on a big parcel of land where I can subdivide it up into potentially 10 lots. So I'll only really look at a sub-regional location when I know on a case-by-case basis I believe that I can't get that desired outcome in a bigger regional hub. So that's my conclusions there, guys. So if you fall into one of those categories, then it's up for debate then whether or not you decide to proceed with investing in a sub-regional market. But if you want to have an additional discussion with me or have any questions pertaining to investing in sub-regional locations, or you want to bounce off a couple of sub-regional locations with myself, feel free to reach out to me and the team. More than happy to have an initial chat with you about some of these locations. There are a couple of sub-regional locations that I would touch, but I'm treading in those sub-regional locations very carefully because some of the data looks very good in some of these markets, and we're keeping a very close eye on them in the short and long term. All right, phew. Thanks, guys. A short and sharp one today. Usually my videos are a lot longer than this, but I appreciate it if you've stuck around and watched all the way to the end. Again, my name is Troy Bassini. I'm the owner and head of research of Capricorn Life Buyers Agency, one of our subsidiary brands under the Life group of companies. And yep, we help buyers, property buyers, investors navigate the regional Queensland property market. And if you fall into any of these categories here, if you're struggling, if you want really good results and outperform the market, if you want to buy off-market property, if you want to get into the better locations, the better streets, the pockets, the dwellings in the marketplace, yep, this is our bread and butter. This is what we do on the ground in regional Queensland. So feel free to reach out to me and the team. You can give us a call on that number, visit us on that website. We service the Central Queensland and North Queensland property market. And yeah, you can reach out to me also, guys, on Instagram if you have any questions or if you want to just learn more about the regional Queensland property markets. I give a bunch of free tips and tricks there on that platform. And if you have any more questions pertaining to regional Queensland and sub-regional Queensland, feel free to leave a comment in the comment section. More than happy to circle back and answer those, guys. And yeah, feel free to give it a like, share, and give me a follow as well if you've really enjoyed this stuff. Cheers, guys, and I'll see you on the next video.